Identifying the specific structural and macroeconomic conditions that produce equity returns of 10 to 100 times requires isolating the mathematics of extreme growth. For publicly listed companies, the baseline of wealth creation is the expansion of market capitalization over an extended timeframe, adjusted for equity dilution. This horizontal bar chart breaks down the drivers of total shareholder return based on historical multibagger data. 59.8% of the return stems from EBITDA growth, while 44.7% comes from valuation multiple expansion. These two variables interact to create a compounding effect. Exponential outperformance occurs when an enterprise scales its underlying cash flows, while the institutional market simultaneously assigns a higher valuation premium to those same earnings. Capturing a multibagger involves identifying the precise operational moment an enterprise triggers this mathematical synergy. Historical regression analysis of 464 multibagger stocks proves that conventional metrics have zero statistical link to extreme future outperformance. Screening for short-term earnings per share growth, or Altman Z-scores, would have eliminated the most successful wealth creators from your portfolio. This failure stems from a recent macroeconomic regime shift. Facing persistent inflation and normalized capital costs, the market has moved toward a regime that rewards turnaround enterprises and deep value upward re-ratings. Operating successfully in this landscape requires moving past traditional screeners to a new structural framework, the policy cash moat triad. The first pillar of this predictive framework is the free cash flow anomaly. This scatterplot highlights historical winners originating in a specific mathematical quadrant, an exceptionally low free cash flow to price ratio. Isolating the internal math reveals the mechanism. These enterprises scale cash flow without proportional capital expenditures, allowing for growth without dilutive external funding. This mathematical base typically requires a starting market capitalization under $500 million. This size ensures the low institutional ownership and market inefficiency needed for significant mispricing. Cash flow provides the fuel, but without a mechanism to protect those profit margins from competitors, sustained multiple expansion cannot occur. The second pillar is the defensibility moat. The valuation multiple only holds a higher level when institutional markets believe the new cash flows are structurally insulated. Monster Beverage generated a 444,000% return by intentionally outsourcing its manufacturing. By leveraging a strategic distribution partnership to maximize return on invested capital, the company ensured that incremental revenues dropped straight to the bottom line. Conversely, NVIDIA engineered a 372,000% return through intense technological vertical integration. This created a monopolistic bottleneck in the global hardware supply chain. In the Indian market, these concepts manifest as the digital toll bridge. This model establishes a functional monopoly over a critical node of financial activity, driving marginal costs to near absolute zero. Central Depository Services Limited illustrates this asset-light ecosystem. As the retail investor base expanded, the financial gains flowed directly to the bottom line because institutional brokerages faced immense switching costs. The transition to monopolistic rent extraction triggers the sustained upward re-rating of the price-to-earnings multiple. The final pillar is the top-down policy catalyst. Exponential growth typically requires a massive structural tailwind. This data from the MSCI China universe highlights three structural traits shared by 10x performers: high realized growth rates, small cap bias, and sector beta. In 66% of outperformance cases, the broader sector was concurrently outperforming, dictated by explicit government strategic directives. BYD Auto aligned vertical integration with state directives to reduce fossil fuel dependency. This policy support allowed the company to decimate internal combustion competitors and reach global scale. Hindustan Aeronautics Limited provides a parallel in India. By aligning with state defense indigenization mandates, the company secured a monopolistic position with multi-decade order visibility. Explicit state policy provides a massive structural tailwind for these aligned enterprises, significantly expanding their total addressable market. The macro catalyst for the next decade is India's sovereign mandate to transition into a $30 trillion industrialized economy. This shift involves a $360 billion direct investment to achieve 500 gigawatts of non-fossil fuel electricity by 2030. Concurrently, the global supply chain pivot is driving subsidies into a domestic semiconductor ecosystem focused on assembly, testing, and packaging. Large-cap utilities and IT firms are mathematically too large to multiply their market caps 10 or 20 times. The true exponential wealth will aggregate in the mid-cap supply chain bottlenecks servicing these megatrends. We can test this framework against the deep value turnaround archetype seen in Hindustan Construction Company. A look at its recent financials shows severe corporate distress and contracting earnings. However, the policy catalyst overrides that distress. The legislative dismantling of the state-run nuclear monopoly opens a 2 lakh crore private sector pivot for an enterprise that constructed half of India's existing capacity. Quick-Heal Technologies provides a test for the SaaS migration archetype. The company saw profit margins decline as it relied on the volatile consumer antivirus market. This revenue chart shows the underlying structural pivot. The expanding wedge of enterprise cloud cybersecurity replaces the shrinking consumer segment. While the consumer side is volatile, the enterprise segment maintains an 80% retention rate, creating a high switching cost moat to force a stock re-rating. Evaluating these companies strictly on trailing earnings obscures the mathematical re-rating triggered by these structural pivots. The policy cash moat triad is the definitive synthesis for the Indian equity market through 2036. Capturing a 100x return requires navigating cyclical drawdowns that exceed 50%. This is a psychological barrier that defeats participants who rely on over-diversification. To succeed, the framework requires precise alignment. Exponential wealth creation occurs at the intersection where mispriced free cash flow is unleashed by state policy and protected by a structural bottleneck. In the coming economic transition, the greatest risk to institutional capital is a strict adherence to obsolete valuation doctrines.